I'm going to walk you through the 10 largest stock positions held by hedge funds. But more important than that, I'm going to demonstrate for you the danger this can present for an unprepared portfolio. Coming up. Hey there, my name is Steven Spicer, and it's my goal to help you invest smarter. If that's something you're interested in, don't forget to subscribe and click that notification bell. I'd love to have you on our team. And now, it can be fun to watch the activity of hedge funds, and more than fun, following them, at least for the last 18 or so years, has been a lucrative strategy. Every quarter, Goldman Sachs compiles a list of hedge fund VIPs. They do this using the 13F filings, where those large funds are required to disclose the details of their long stock positions in their portfolio. These hedge fund VIPs are the 50 stocks that are found most frequently in the top 10 holdings of notable hedge funds. Does that make sense? So you rank the holdings by total market value of notable hedge funds. Now, Goldman follows 830 of them to find this number. Those 830 represent $2.3 trillion in investment dollars. So you rank the holdings of each of them. The top 10 stocks at the top of each of those 830 lists essentially get a point. There's a lot of overlap across all these funds. A lot of them are holding the same stocks. In fact, we'll look at how true that is, more so today than ever before, later in this video. Now you make a new list of the 50 individual stocks that received the most points, and now you have the 50 stocks that rank the most often in the top 10 holdings of these notable hedge funds. And that is Goldman's Hedge Fund VIPs list. This list has outperformed the S&P 500 in 62% of quarters, on average realizing 2.2% higher return. So a lot of people like to pile in and follow along. It makes sense. Seems like a good strategy, right? Why not? Ben Snyder, a Goldman Sachs strategist, says, from an implementation standpoint, the hedge fund VIP list represents a tool for investors seeking to follow the smart money. Now, we'll look at a list of some of those stocks in a second, and then we'll look at why this is all more concerning today than ever before. But first, I think it's important that you understand the problem this piling in effect can have. We're at a unique point in our market cycle, as we arguably enter territory, making this one of our longest bull runs ever in history. Investors are acutely aware of the possibility of a massive crash. As optimistic as these fund managers may be, you better bet they're watching for it. As a hedge fund, that's their time to shine during those dramatic downturns. So even if you don't expect the market to crash anytime soon, that doesn't necessarily matter. Sometimes the perception and psychology of everyone else around us can have a significant impact on the performance of our investments. As an investor in the market, it's important to understand and pay attention to that, because the more people there are that are worried about that, the more likely it is to become a self-fulfilled prophecy. When markets get to this point, at the first sign of stress, investors stampede to the exits.
Don't stampede, no need to stampede, sir.
And this phenomenon can make a bad situation significantly worse. Allow me to try to demonstrate this with a simple example. Let's say you find a small stock that you think has high potential. You buy some shares, but later you find out that 80% of the rest of the shares outstanding are equally owned by just 4 hedge funds. Does that make you feel better or worse about your position? Now, it shouldn't change how you feel about the underlying company. You did solid research, you understand the fundamentals of that company. It shouldn't change how you feel about that. But it probably should affect how you feel about the way you are uniquely able to play this particular opportunity. Think about it. If there is some sort of panic, or if for liquidity or whatever reason, 1 or 2 of these funds decide that they need to get out immediately, what does that do to the stock?
Sell, 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 sell.
A rapid sale of 20% of the shares outstanding would severely damage the price per share. And if another fund found out about it just as, or perhaps right before the first starts to exit, do you think they're going to wait around for the resultant significant price drop, or risk being so exposed should another firm rapidly leave? Maybe. Or maybe there'd be a race to the exit, one that would likely trigger the attention of and reaction from the other two funds. And as these massive funds are piling on their selling pressure, driving the stock's price lower and lower, that humble average investor who is just patiently waiting for new information before making any rash decisions can't understand why day after day, week after week, the stock's price just continues to crash. This is a made-up extreme example to hopefully illustrate the potentially disastrous impact this clustering by large funds into relatively few stocks can have on the average investor. And if there is an all-out stock market crash, like one for the history books, it'll be those stocks, because of this clustering, that could be damaged the most. During a crash, you don't want to be in those crowded positions. As investors start to stampede towards the exits, it's not women and children first. It'll more likely be old, rich, white guys or hedge fund managers first. And as usual, the average everyday investor gets hurt the worst. In Stop Investing Like They Tell You, I point out that as markets free fall, it's the disciplined investors who hold out the longest, because that's what they're told to do, and end up suffering the most prior to their ultimate capitulation. So as I noted in the beginning of this, when everything is going well, following these fund managers can be a lucrative strategy. These are good, solid companies that they're piling into, obviously. That's why this is happening. But the prudent investor should take note of this reality and at least prepare themselves mentally, or even better, set up some sort of downside hedge for these crowded positions. I'm talking about hedges like those I've mentioned in other videos and will continue to help you with in the future, so don't forget to subscribe. So let's get to that list of stocks. Now, that Goldman list was released at the end of 2018. They'll be releasing a new one soon, and I'd be happy to create a video about it when it comes out if you want, so let me know in the comments. But I didn't want to wait that long before bringing these concerns to your attention. I would have felt bad if something happened next week and I hadn't said anything, for example. So instead of pulling from that old list, I'll pull from the most recent information on this that I could find. It comes from a Wallet Hub analysis of over 400 top hedge funds. According to their research, the 8th, 9th, and 10th most widely held stocks in these funds are 3 of the 4 large US banks: JP Morgan Chase, ticker JPM, Bank of America, ticker BAC, and Wells Fargo, ticker WFC, respectively. The 7th most popular hedge fund stock from this list is Visa, ticker V. Then you have United Health Group, ticker UNH. And then the tech-heavy top, which, by the way, aligns very closely with the Goldman list. At number 5, you have Alphabet, ticker GOOG. Number 4, there's Facebook, ticker FB. Number 3, you'll find Apple, ticker AAPL. Number 2, you've got Amazon, ticker AMZN. And finally, at the top of this list, and also conveniently boasting the title today of the largest company by market capitalization, it's Microsoft, ticker MSFT. Now, the Goldman list from the end of last year consisted of many of the same stocks. The additional 4 on their list were NXP Semiconductors, ticker NXPI, Alibaba Group, ticker BABA, PayPal Holdings, PYPL, and Comcast Corporation, CMCSA. Which of these do you own? Any? Let us know in the comments and let's talk about them. Now, the stocks on those lists probably weren't much of a surprise for you, but here's the part that really stands out. The part of this equation that makes these stocks, for the aforementioned reasons, more dangerous today than ever before. The problem today is that the average density of hedge fund portfolios is disproportionately skewed into these top 10 holdings. Let me explain. That Goldman study indicates that the average hedge fund held 70% of its long portfolio in its top 10 positions. That's the highest it's ever been since they started tracking this around 2002. So this means that hedge funds have more money allocated to their top 10 stocks than they have had in at least the last couple decades, which means that there's a lot more selling pressure that will hit the market should those managers see something that concerns them about the market in general or about these stocks in particular, and they start sneaking out the exits before you even know what's happened. ultimately leaving individual investors vulnerable to sharp sell-offs. So if you find a large portion of your own portfolio also crammed into one of these popular stocks, I'm not saying they'll be a bad investment over the coming years. In fact, I specifically cited evidence to suggest that they could be great. But I am saying that you should prepare yourself mentally for the possible extreme scenarios and ideally financially by hedging your portfolio accordingly. Again, we've talked about hedging strategies in the past and we will continue to talk about them in the future. So if you're interested in investing smarter, don't forget to click subscribe and hit the notification bell. I look forward to getting to know you better and helping however I can. Take care.